Africa, but also from across the world, helping them to make seamless investments on the continent. So please welcome Sandrine to help us moderate the panel.
Thank you. Good afternoon, everyone. You guys sound a bit lively. After lunch, it's funny, we always have a tough job having a panel right after lunch. So my personal goal is to, number one, keep you guys awake. And then, of course, number two, being able to really share some of the perspectives that all these gentlemen have, all their incredible experience. These are the people who are doing the work day in, day out, and really have their pulse on the state of African private equity. So I'm really excited to be having this conversation. But I really want to just dive right in and start with some introductions. And so if every panelist could please share a little bit about yourself, your background, your company, as well as share where your company really falls in the PE value chain. And Chris will start with you.
Thank you, Sandrine. Good afternoon, all. Happy to be with you. My name is Chris Oshafi. I'm Nigerian, and I work for a company called Pan African Capital. It's primarily an investment bank, working with quite a number of PEs across the continent. And we also work with PEs in several sectors. And I'm happy to share my experience with each and every one of you. Thank you and welcome.
Hi, my name is Trent Hudson. I'm from the US, but live in South Africa. I work with an investment holdings company called Fairfax Africa, which is a listed investment holdings company with focus in equity-like investments in Africa.
Good afternoon, everyone. My name is Chuma Jene. I work with Atlas Mara. Atlas Mara is a listed permanent capital vehicle investing in financial services across Africa. We've been doing that for over 5 years. And since then, we've invested in about 7 countries in Africa, from Nigeria all the way to Botswana. Pleased to have you guys here and looking forward to the discussion.
Good afternoon. My name is Jalil Bensouda. I'm the managing partner of McKinsey & Company for French-speaking Africa, which includes North Africa and West French-speaking countries. We are working extensively with large PE firms, mainly on due diligence for their acquisition across Africa, and doing also some works for the turnaround of some specific assets.
Thank you. So the title of this panel today is Investing for the Future of Africa, the Role of Private Equity. And I feel like if we're going to have a conversation about the future of Africa, we need to be able to at least turn around and take a look back at what's been happening in the past, and at least the recent past, in the past couple of decades. Because the story of African private equity has really been one of ebbs and flows, right? So we've had 2007, we had $8.3 billion injected into Africa. Then we had a downturn. 2014, another $8.1 billion. And then the following year, just around $3 billion. And so we've been having this trend of volatility over the past few years. But then if you fast forward to 2017, we have KKR that disbanded their private equity team. You have Abraj in 2017 in June that essentially fell apart. And then we have in February 5th of 2019, so just a week and a half ago, we have Blackstone that pulls out of Africa. And so from the outsider looking in, at least the average Wall Street Journal subscriber, they could probably take a look at Africa and be a little bit confused, wondering what's going on. And so I'd like to start off by talking a little bit about what these headlines, what this perceived volatility means to fundraising, people who are still in the game and who are doing the work. So Chumbo, if you would actually start off and share what your perspective is on that.
Thank you. The fundraising market has obviously been very difficult, complicated by a number of things. I think it's obviously not good news to see the likes of Blackstone, KKR, Abraj, not doing so well in Africa, it doesn't help the story. But I think part of the reason why fundraising has been very difficult is many investors have observed that many private equity firms or firms looking to raise capital don't necessarily have the right model. Africa is a very difficult environment. Africa is not 5-minute or 2-minute rice. It does take time to achieve returns. It does take focus. I think in a number of instances, a number of the institutions you highlighted take a general approach or Pan-African approach to investing in Africa, and obviously take a fixed-term approach, which is usually 5 to 7 years. There are issues with several of those institutions that really center around the model. Atlas Mara, for example, we are focused on ensuring that our vehicle is permanent capital, so we are not forced to enter or exit at certain times. That is a big advantage because you have to be opportunistic when you're looking at investing in Africa. Whether it's currency volatility, whether it's other areas of macro volatility, you need to be able to know when to enter and when to exit, and you need to be able to do that without being compelled by your LPs or your investors. The other thing we do is we focus on 10 to 15 markets. As much as we say we are a Pan-African investor, we have identified that within Africa there are 10 to 15 markets that make up the bulk of the opportunity. So as much as we're Pan-African, we're focused on where we believe the most returns can be made in the medium to long term. I think many models tend to be focused on all of Africa and not really having a thesis as to why West Africa versus East Africa or versus Southern Africa. So I think that focus, that ability to invest at will and without a fixed term is a huge advantage that I think many new models that are emerging need to adapt.
And that's a conversation that we'll also be diving deeper into, this idea of what works in Africa. And of course, we all know there's a tremendous amount of markets within the continent, but understanding the nuances and the structure and having that creativity can certainly be an asset. But I'd actually like to talk a little bit about the interest within the continent for raising capital. And Trent, Chris, and Jalil, you all are based on the continent. So can you talk to us a little bit about what that environment is like, raising capital from within Africa, and how can we continue to increase that momentum?
I think there is a great momentum on Africa, but the reality of investing is quite challenging, as Chuma said, because Africa is 52 countries. There is a lot of ups and downs in many countries. Political instability, devaluation, like in Nigeria, that creates not the optimal conditions for investors to invest. So if they don't have this long-term view on creating value, it will not work. So each time that you have a large inflow of announcement of new funds in Africa, the reality is that the PE firms were not able to deploy all this capital into Africa, and it creates a lot of mis-expectation from the investors. And at the end, today, especially with the Abraj, with what happened with the Abraj, the level of compliance that is required by the investors have raised, which means that today even the raising funds starts to be more lengthy process for much of the PE firm. I work for a PE firm that was, for example, his first fund, they raised $700 million. They were ready to raise $1 billion this year, and they are just raising a first round of $300 million for this quarter. And their investors want to see the capital deployed, and they want to see also the returns of their investments. So a lot of expectations, but the reality is quite challenging. And the operating model, like Chuma mentions, is critical because you cannot replicate what you do in the US or in Europe.
Trent or Chris?
Okay, let me go. Thank you very much. When you look at fundraising in Africa, like Jalil said, Africa is 52 countries. You find out that there's a lot of diversity between countries in the West, countries in the East, and countries in the South. So it's always very difficult for you to talk about capital raise for domestic capital accumulation for investment in those markets. But I think one of the biggest challenge is culture. We also need to understand that the culture is also different, culture is diverse. If you ask around this room, how many family offices do you have in Africa? It's difficult for you to find a family office that is thriving. How many businesses in Africa have transcended decades and centuries, unlike you have in the West? And this is how you accumulate capital. So if you cannot accumulate those capital from those kind of family offices, then it's always going to be a challenge to have domestic capital for investments in long-term yield type of projects. The second thing is regulation. If you look at the regulation that we have, most of the pension funds that you have across the continent, these pension funds are highly regulated in such a way that they don't have access to invest a lot of their monies in PEs. And this again is a big constraint. Look at insurance companies. Again, they are highly regulated. So when you look at the challenges in raising funds across the continent, it becomes very difficult to raise the kind of long-term funds that would be able to deploy into private equity type transactions. So that's the challenge that I think for us to deal with that, traditional PE firms must find a way to resolve this challenge so that the model can fine-tuned to grow in Africa.
Yeah, I think kind of building on a couple of sentiments that Chris raised. I think that when you think of private equity in the context of a Pan-African strategy, and then you try to think about raising local capital for that, I think you will find some of the challenges that you raised around cultural differences, comfort levels in certain geographies, but not in others. And I think when you couple that with, I think, some of the inherent structural challenges of the traditional private equity model, where you have a Pan-African fund that has a certain window of time to make and then harvest those investments, how do you think about cultivating very regional partnerships where you may look at raising capital on a deal-by-deal basis, but you're then caught in a very sort of fund level issue of an exit horizon. So how do you think about building those type of partnerships whenever you really have to have control over timing of the investment? And so I think those are some inherent challenges with it from a Pan-African private equity strategy of raising local capital.
And so we've been talking a little bit about the challenges with fundraising, but I would love to hear kind of what keeps you up at night when it comes to the operations. So is it talent, is it currency? What really do you struggle with when it comes to actually moving forward with the deals, hoping to move towards that exit? I'll have everyone jump in.
Okay, I mean, it's interesting you asked that question. I would have thought what should keep you up at night is to try to innovate and deepen the business. Unfortunately, that's not what keeps you up at night. You're sleeping in a place like Nigeria and you're told 5 hours to the election day that the election has been postponed. How do you want investors to react? How do you want companies to react? So the level of uncertainties in the macroeconomy is something that will keep any investor up at night. Of course, you wake up in the morning and you are told that your currency has been devalued 20%. Again, all your models that you've done, all your MBAs that you have in your office, and done all the models, you wake up in the morning and the story is different. So you have those political risks, you have those economic risks, and of course you have even the risk for talent. How do you hire talent and how do you retain those talents? hiring talent is one thing, but retaining them is the bigger part of it. So these are some of the major challenges that keeps you up at night and makes some of the investments that you make turns out.
Can we just stop for a minute? Can you please raise your hand if you would like to create a fund, work for a private equity firm, or work with a private equity firm? So this is your pool. Perfect. All right, Trent.
Yeah, I think echo a lot of that. I think certainty in a couple of areas are some of the big challenges to think about. I think when you do make an investment, actually realizing the potential of that investment. I think policy certainty is a big one. We have investments in the infrastructure space, and so these are these types of policy changes that can be can kind of sort of come overnight and totally change the investment thesis that you may have made. Execution certainty is also I think one of the key risks that you face, and it ties somewhat into the question of sort of the regulatory environment, policy environment, and then just the inherent execution risk that you face in some of these markets. And so I think those are some of the things that once you launch out on an investment, that you keep up, keeps you up at night.
Yeah, I think some of the salient points have already been made, but the only one thing I would like to add to that is integrity. As controversial as it sounds, I know that Africa is unique in this regard. In a number of investments we've looked at, or even companies we've invested in, we have good talent, some smart human capital, people who are actually able to get the job done. But when you're an investor, you're not on the ground 24/7. Being able to trust, your management teams, even having a level playing field with your competitors, and just making sure people are not going to do untoward things to undercut you or outcompete you. That is a significant, if I can call it, worry that keeps us up at night when it comes to investing in some of the markets that we've invested in or are looking to invest in. That level playing field and integrity underpins that as critical, and it's not something to be taken for granted. When you start investing in Africa or start investing in emerging markets as a whole, where rule of law or enforcement of laws or regulations are not as tight as developed markets, integrity starts to become a much bigger deal than it would in other markets.
One of the main challenges for the private equity firm that I work for is really how to build a balanced portfolio of assets across the continents. As Christopher said, there is a lot of risk in all the countries. There is volatility, so they cannot be exposed in only one sector or one country. So for them, when they have any window of investment of 4 or 5 years, is how to build this portfolio of 10, 12 positions that will allow them to go over the cycles. And 4 or 5 years in Africa is quite fast, because each deal takes between 6 to 18 months to complete. So they are always a run to find the right asset and the right balance between the different positions. And there is also, with the different compliance constraints that have raised in the last months, they look for more sizable assets, because they cannot take any more, especially for the tier 1 private equity firm, the $10 million position. They are more looking now to $40, $50 million, and you don't find that much assets with this size, which link the question about who is taking care of the mid-sized company in Africa, because it's all the flows is how it's targeting the big size, the big companies. There is not that much opportunities if you see across the country.
And that's a really big question. That idea of a missing middle who services those smaller sized businesses that don't need the $40 million or $50 million of capital, right? Do you all feel that that is the responsibility of private equity to be able to come up with products or investment vehicles that can serve that missing middle? And if so, how do you believe that that should play out?
Sandrine, thanks for that question. It's really important that if we are going to get the middle-sized companies getting model right, then we'll have to alter the structure completely. The structure of how PE firms come into Africa has to be altered. First, there is a market. Next, they don't require the kind of large funding that some of the PE firms will want to bring in. Most of the PE firms perhaps have maybe $500 million of fund, maybe $1 billion of fund. But what you require, what the mid-sized firms require, is much, much smaller than that. But I think the missing link, and I think we need to deal with that fundamentally, is that Africa itself does not trade with itself enough. Africa does not trade with itself enough, and that's intra-Africa trade, which today is about 13%. Trade within Europe itself is about 60%. Asia, maybe about 55%. America, maybe about 50%. Now, that is the only engine for growth and development. If Africa does not trade with itself enough, then it's going to be a problem. And why don't they trade with themselves enough? It's not about capital and all that, but it's about trade information. And I just tell you a little bit of story. Sometime in 2009, in Nigeria, there was a huge deficit of millet in Kano. Kano is just a few kilometers, about 5,000 kilometers up north to a town in Niger Republic. But what happened was that there was an abundance of millet in Niger Republic, which is about maybe 4,000 or 5,000 kilometers. But there was scarcity of millet in Kano, which is just across the border. But that information wasn't available. Because what happens is that most companies in Africa that are mid-sized would rather deal back with their colonial masters. Nigeria would deal largely with Britain or whatever. Cote d'Ivoire would deal largely with France and other colonial masters. So we ignore the fact that there's a market within Africa. There's a market both on the supply side and on the demand side, but that information is not available. I would rather go buy something in Europe rather than come and buy something from nearby Senegal. So we need to deal with that. And once we deal with that, then you create value. There's a value capture among the mid-sized companies, and then PE firms will have something to tap in on. I think if we don't solve that, then we'll keep going round and round and round looking for solutions for mid-sized companies.
Yeah, I'll flag an issue, I think, for us that we've dealt with in sort of, I guess, smaller investments, sort of as a larger investment vehicle, 50 to 100 is sort of our sweet spot as well. I think one of the benefits that we have as similar to Asmara as being a permanent capital vehicle is it allows us to be a little more creative in how to structure and invest more in platforms. But some of the platforms that we've invested in, for example, we've invested in a Pan-African foods and foods processing business. And so they look across the continent at exactly these type of businesses. And one of the biggest challenges that we face in being able to actually make any investments is and I think there is a very constructive role for some of the DFIs to play, but one of the challenges that we've had is that they play the role of competitor, and their cost of capital is very low. And so the type of valuation that they're willing to pay versus what we can justify paying relative to the risks in these markets is we just can't compete. So we get priced out in whether it's I'm not gonna name names, but a variety of them will come in with very out of market pricing, and that puts pressure, I think, on the private sector, on the private equity ability to come in and participate in those types of investments.
Thanks, Trent.
So my view is private equity may not, I mean at least the large cap private equity may not be well suited for addressing the problems of the missing middle. And this is where, alternative sources of capital need to come in. Whether it's, the public sector, or even within the private sector, whether it's microfinance institutions, etc., that need to continue to support the missing middle. But in terms of what we do as an organization and how we're trying to address that, especially within the banking sector, which is where Atlas Mara focuses on in terms of investing in Africa, is we tackle that missing middle challenge with a consolidation proposition. In Africa, there are too many banks in some countries. And yes, some banks are focused on, serving the missing middle. But the reality is it's very challenging to do so. It's very expensive to do so when you don't have scale. So our solution, to that problem is by consolidating, by creating national or regional champions that have the balance sheet, the patience, and the strength to be able to, if I can call it, take riskier propositions in terms of lending more to SMEs, lending more to retail, which is a huge opportunity in many markets, and using that as a channel to actually reaching the missing middle. But private equity in and of itself, especially if you're going to go through the very difficult and lengthy process of raising a fund, even if it's $50 or $100 million, you typically want to concentrate your investments in 5 to 7 companies with that level of a fund. And, smaller businesses or businesses in the missing middle tend to be, they require obviously a lot more hand-holding, a lot more operational support. And if you're a $50 to $100 million fund, it's very difficult to have all the resources to devote towards companies in the missing middle. So there are various ways of obviously tackling that problem. We're obviously trying to be part of that, but it's not just up to private equity to solve the problem of the missing middle.
Yes, exactly. So the cost to serve the mid-size is, you cannot afford as a private equity firm to do so. So there is some alternative models that are pushed by many governments to do so. So either, I have an example in Morocco where the Moroccan government has put some $30 million funds that he gave to a private equity firm to manage on behalf to him to serve this kind of investments, taking the risk of investment, and the private equity firm is mainly playing the role of investing and making the right choices. You have also some other financing tools like guaranteed funds. DFIs, they love that because for a small portion of fees, they are able to leverage their funds and to be able to target those kind of SMEs. So definitely we need to be innovative in the way that we finance those small market, but it's not really it's not economically viable for PE firms to ask them to do so because it's not really on their economic model, especially that scale matters. And I say with the level of compliance, with the level of CSR that is required, you cannot, make a fund below $200 to $300 million viable in the current conditions.
That idea of innovation, I think, is incredibly important. And with that, I want to circle back to our conversation about structure, because we've essentially said that you need to be more creative, right, in terms of ways that you're thinking about structuring a fund or structuring an investment vehicle. But are there any specific characteristics or themes that you've seen within the private equity community of funds that you feel like have worked well? And I know it's inherently kind of a nebulous idea because you are dealing with different markets and different sectors. But I'm wondering if I'm someone who wants to start a fund, where do I even begin when I'm thinking about what structure to utilize? Trent, we'll start with you. You're nodding pretty
Well,
intently.
I mean, I'm certainly, I guess, biased in this because I think we were very fortunate to partner with an investor like Fairfax who's very long-term, and that's their whole culture is defined by we invest for the long haul. We're going to make a return, not in 1 year, not in 2 years, but over a long horizon. And so I think permanent capital is the new model that a lot of people are focused on. I think you've seen that happening over the last 2 to 3 years. We certainly, that's the model that we went with. And I think we're in a listed permanent capital vehicle, but I think we're actually even unique in that structure because we have one controlling shareholder. So we, not to bore you with the details, but we have a dual class listing where Fairfax, while they only have a certain percentage of the funds maintain control. And so I think for us, that gives us permanent capital, but also an alignment on being able to make decisions for the long term, not being dictated by short-term market sentiment. So I think permanent capital is a very important innovation in the African context because of all the issues that we've outlined. I think the primary one is just time. You really have to have time to close, time to execute on strategy, and I think if you're faced with the demand for an exit in a 5 to 7 year window, it can create a lot of problems.
Does anyone else have any thoughts on characteristics that work well when it comes to structure?
Maybe just to add to what Trent just talked about, is perhaps walk along the lines of helping the supply chain. Because you find out that the difficulties you find in Africa, again, back to the issue of currency, is what kind of project, what kind of sector that you invest in. If you invest in sectors where the receivables are local currency, then you probably will be back to the same issue. You come in and then you want to exit, then it becomes difficult. So the issue of supply chain, dealing with supply chain is always very, very important at the beginning of that investment. And I think factoring that kind into the structure would perhaps help the PE firm in exit.
Maybe the only thing I'll add to that is around, and I said this earlier in the conversation, that focus. I think if I were to go out and raise a fund today, it would have to be specialist. I think there's a dearth of deep industry knowledge in some private equity funds, and I think if you were going to go out and raise a fund, and it's not just about raising the fund, but actually creating value or achieving returns, just being able to have that sector expertise within a certain industry as opposed to being generalist and sort of being one size fits all, I think will be a significant differentiator in creating value. Similarly, obviously, sector expertise is one thing, but also regional or country expertise is another. And I think we're starting to see some of this actually evolve. We're seeing more country-specific focused funds or regional-specific focused funds, because as nice as we like to call Africa one place, it is very mixed and very complex. And just picking your focus, I think, is critical if you're actually going to be able to meet the returns that many of the LPs or investors want to have.
What I have seen recently is that, as Trent had said, is the creation of a platform, sectorial platform, and it's also a way to tackle these mid-sized companies. So what they do, some private equity fund, I know two of them that they are dedicating a fund on pharma and another one on education. It starts to buy a big acquisition and make this acquisition grows and create synergies between the different business in different countries. It's also a way for them to get leverage based on something that is quite significant initially, and it's create synergies in terms of expertise and knowledge. And there is some sectors that are quite keen to invest in that sense. I think agri is a clear one across the continent. Education and pharma also may work. It doesn't work in all sectors, but it's a way also to scale up and make those investments more Pan-African and specialized.
And we have a couple more questions, but this next question is a little self-serving, quite honestly, because I work with US-based investors who have an interest in Africa, and we believe with Invest Africa that we are not only responsible for taking care of the people who are currently interested in Africa, but also helping to grow that pool. And so as I look to the next generation of investors, I'm thinking about where are they raising their capital from? And there's so much money that really sits in the US, right? And so as you think about fundraising and as you think specifically about the US market as an opportunity to pull more capital from, what are there specific types of investors that you're looking to target? Where, just to give some people some ideas of where some flexible capital could potentially be as they move forward in their roles in PE. I'll probably start with you, Chuma.
Yeah, so, at Atlas Mara, I think what we realized is there were a lot of, US traditional investors, and these are not your typical LPs in terms of pension funds or family offices, but these are, traditional asset managers, people who actually invest in public markets, but, only have limited opportunities to do so in Africa, given, if I can call it, the depth of capital markets. So we came up with a listed vehicle concept, which obviously has its challenges, which I can talk about in more detail. But it's really, you need to look at the US market and say, look, where are the opportunities that are untapped? And I think that's what we realized. There are many public market investors who wanted exposure to Africa but couldn't do so, because they didn't understand the opportunity as well, but also didn't necessarily even have approval to invest in Africa. So what we did was we created a London Stock Exchange listed vehicle, so it qualifies as, you invest in on the London Stock Exchange. But really the value proposition is you're getting Africa returns by investing in Nigeria, Botswana, Tanzania, etc. So I think one needs to think outside the box. One needs to be innovative. One needs to, match what the opportunity or the investors want to the opportunity. There's no one prescriptive way or, only one segment of investors to approach in the US. There's multitudes of pockets of money here, and just being open-minded around how you structure to meet the needs of those investors is critical.
Yeah, I think that's right, because I think certainly from our perspective, I think the U.S. investors that we engage with and have engaged with versus, say, European investors, I think the U.S. investors have a larger learning curve in terms of understanding investing in Africa. And so I think trying to find ways to sort of lower the barriers of entry through, London or Toronto-based listing, I think can help bridge the gap.
Yeah, I think I agree with that. Trent and Chuma they've done justice to that. But just to say that if you look at the way the US investors are also structured, most of them don't have knowledge about Africa. and that's a major issue. So they need to understand Africa. Some of them will probably believe Africa is just one country. It's not. Africa is, as a Nigerian, if I need to go around Africa, I need to get visas to 38 countries in Africa, and that's a major challenge. You know, I need to have visas to 38 countries, so that's a major challenge. So an investor who wants to get into that territory first has to understand the territory itself before they begin to make investment decisions or whether they want to put money in it or is going into it. So that's also very critical.
And you're saying that it's your job as the fund manager to educate the investor, potential investor, on that market then?
Absolutely. So we need to do a lot more as fund managers, as firms, to get the information that is required across to those classes of investors to be able to get them.
What strikes me is that you can find the biggest investors are only foreign PE firms. We don't have really at that stage a Pan-African local equity firm, except Africa Invest, which is based in Tunisia, would have been able to raise several funds in the last years. All the major investors are GPI, Helios, Carlyle, that are US-based firms. So there is still a question about trust between, I think, the investors and Africa, and they need to go through some how to say, European or US-based PE firm into Africa. And I think we should still encourage the creation of a local PE firm. There is some in West Africa, but they could be, how to say, focused on small market with small size. So now the question is, how do we make them bigger and, how to say, attractive, especially for those talents that are in the world.
I think it's safe to say that you guys are pretty optimistic about the opportunities in Africa, even given the recent perceived volatility. But can I ask you all, is the promise of alpha returns for PE investors in Africa, is that realistic?
I think I'll say yes, it's realistic. That's a difficult one, but I'll tell you it's realistic, but it depends on what sectors you want to get into.
What sectors are those?
I said, education, for example, there is a huge potential. Health, there is still a huge potential in the continent, and you always find some new economic model that will allow you to address the market. If you go into the crowded market like banking and insurance, it's clear there is less attractive today, but there is still some new, how to say, sectors that needs to be invested. Agriculture also, there is huge potential that can be captured. So I think the PE firm should be more innovative and more focused on some sectors. And as I said, I believe in specialized fund, Pan-African fund, but focused on one sector.
I think that achieving alpha returns in Africa is realistic if the investor is realistic. I think you have to be opportunistic in some of these markets. You have to know when to get in, when to get out. You can't be too greedy. So timing, I think, is a key part of, as much as a lot of the hard work is operational, etc., but you've got to get the timing right in order to deliver alpha in Africa.
Yeah, I think if any of us said no to that answer, we're in the wrong industry, if that's the way we felt. But I agree. I think it is possible, but I think all of the factors that we discussed today, you have to go in eyes wide open, because actually realizing and executing, whether it's making sure you're focused on the industry, you've got the right partner, you've got the right structure, all of those things make realizing that a challenge, but certainly achievable.
Well, just to push it a little, Sandrine, I think we all have come to an agreement that alpha returns are actually possible, but depending on the sector. And I think Jalil had mentioned some of the sectors that you can have those kind of returns. But just to push it a little, the chocolate market worldwide is $120 billion. Now, Africa, between Nigeria, Ghana, and Cote d'Ivoire, provides close to 75% of the major raw materials for that industry, which is cocoa. Of the 120 billion, Africa creates only a 10% value, which is about 12 billion. Now, that's a massive gap. If I produce 80% of the raw material inputs that's required for it, but I get just 10% of the value, it tells you that there's a big gap. And that gap for us is in processing, because most of the things that we take out, the consumption is done in Europe and America. And if that's where the consumption is, then that's where the price determination points will be, because you can't determine the price of value that you do not create. So for us, we believe that those kind of returns, you can get them in places like Africa if you determine the sector right, you have the right execution strategy, and you put all that is required to tap that value in Africa and make processing involved rather than making just the consumption.
I hope you all were taking notes. But thank you all so much for your perspective. I think certainly there's plenty of questions in the audience, so we would love to.
Yeah, so any questions?
And I hope you all know the general ground rules. Please, we would love to know who you are, direct to the point, so that we can get as many questions as possible, please.
Hi everyone, my name is Josephine Oshiafi, and I'm a lawyer. I practice corporate law in New York, and Sandrine, you're awesome. I've heard you speak at a couple conferences in New York. So I have two questions, one directed to Chris Oshiafi and the other to Chuma. So my question for you, Chris Oshiafi, is the Africa Continental Free Trade Agreement. I guess the design really is to increase intra-Africa trade. Of course, there's some holdout signatories right now. And I wonder, what are your thoughts as to how that agreement can actually improve intra-Africa trade, or should we be looking at other means, and you suspect whether the agreement might actually be helpful for intra-Africa trade? And for Chuma, you had mentioned that Atlas Mara has, I think you said permanent capital, if I'm not mistaken, and I want insight into what that looks like, because one of the issues we're talking about is structuring. How are you different from other PE firms?
That sounds great, yes.
I don't need yeah, thanks so much for a beautiful presentation. I think it's very fantastic. My name is Yomi Nigeria. I want to talk of the point that I made by Anjani and Chris Hoffman about education. We often find out that most of the time, when you have investors in Nigeria, one of the things that we should scare them is that we don't have human resources, skillful resources that they will need to sustain the investment. Oftentimes, we are overwhelmed with expatriates in the country. Meanwhile, we have unemployed citizens. Here's my question. Now, what effort have you or your company made to invest into education in Africa? That's number one. Number two, we realized that about 5 years ago in Malawi, the government of Malawi decided to train nurses for 4 years on national resources. After 4 years, UK came knocking, and they hired virtually all of them. So they were trained on Malawian resources, and they were hired by UK. So how do we make sure we stop all of this? If you have hundreds of billions of dollars pour into the country, and the country relies on expatriates, so how do we then give back to the community where they make this money? So that's my question. How do you engage?
Should we answer that round first? I think we have 4, because we have 4 questions there. So maybe we should answer that round first before we get to the Okay, let's take one more before we
Thank you. Thank you once again for a very thought-provoking discussion. My name is Aki. I'm a former PE fund manager in Africa. I had to move on to other things. Before I left, people were floating the option of private debt as an alternative to private equity. I just wanted to get your thoughts on that, since with private debt you have a bit more flexibility in terms of how you structure the repayments. Thank you.
All right, Chris, it seems like you're up first.
Okay, thank you. Thank you, Josephine, for your question on intra-Africa trade. Yes, I think for us it's a very good development. We believe that the major issue the Free Trade Zone Agreement is going to create is first to deal with the issue of movement. Like I mentioned earlier, 54 countries in Africa. As Nigerian, I only have access to 16 of those countries because of the ECOWAS Treaty. 38 countries, I need to get visa to go to those countries. Now, if you want me to invest in some of those countries, then it's going to be a major challenge if things as little as visa to move in and out is going to be very, very difficult. I tell you this, Aliko Dangote is invested in the cement plants in 17 countries. And I know what he goes through trying to get access into those countries because he has to obtain visas to go in. So what this is meant to do is to create that free movement across the region. The other is has to do with currency. You find out that most of the African economies are largely commodity-based, and that's why you have massive devaluation happening. Oil prices go down, Nigerians are sneezing. Price of cocoa goes down, the Ivorians are in trouble. DRC, something happens to prices of mine or cobalt, that's usually because they're based largely on commodities. What this is also meant to do is to create a relationship amongst the currencies. I tell you this, if you go to, let's say, Accra to buy, for instance, there's this piece of textile called Udine that is very popular within Accra and that is exported between Ghana and other countries. First, I have to convert my Naira into dollars, and then I take the dollars and go into Accra, and I get into Accra, I convert back to cedis, and then I buy it, and I get my goods into Nigeria, I get into Nigeria, then what do? I sell in Naira, I then do a second round, I convert. So you are going to have a lot of issues with those kind of trade. So what this is meant to do is also to create, can we have a one-stop currency for the continent, even if it's on a trade basis, that cuts out the fact that you have to keep going from one currency into another, and then there are quite a lot of lag time and losses there. Nigeria and South Africa today are holding out, which is why we have not, that agreement has not been fully executed, and rightfully so, maybe quote and unquote, because these are the two biggest economies on the continent. So they know that perhaps the view is that they might have bear the brunt of it if this goes full steam. So that's why they are holding it. But I think consultations are high in every sphere today, and I'm very optimistic that this agreement is going to be signed and it's going to be a major catalyst for the intra-Africa trade to grow. I think Yomi asked about education. What are we doing as a company? Let me quickly say this. 4 years, I run an investment banking firm. 4 or 5 years ago, we realized that it was difficult to continue to operate because we were operating in Lagos, we were in Nairobi, and we were in Accra. And it was difficult to continue to run because that business requires a lot of talent. So what did we do? We had to create what we call a PAC Academy, a Pan-African Capital Academy. And what we do with that academy is that every young school leaver that's done a mandatory 1-year service gets recruited into that academy. The idea is that for 1 year, you go through a lot of training that prepares you for the goal, the challenges that are ahead. And I think from our perspective, we believe that most companies should be able to do this, and then we'll create that platform that we all need to take the industry, the continent to the next level. Thank you.
Yeah, regarding education, it's clear that it's a big challenge in Africa, and we have seen the failure of the different governments to tackle that. It's the reason why it's created an open space for investors to get in that field with different models you can have from K-12 to universities, and so low, mid class, and upper class. So what we can see now is that there is a huge investment in that field with quite good results. It's clear that it's not the role of the private sectors, but the space is free and it's needed for the development of Africa. Just to see about your question, what we are giving back to the African continent, McKinsey has launched a program called the Generation in partnership with government, and we launched it in Kenya in order to take child and unemployed youngsters and to train them. And in 4 years, we have trained 25,000 students that now are ready to work on the thing. So it's a program that we are trying to replicate in many other countries. So it's point of contribution. So we are playing the lead role and trying to find funding from government and private donors in order to get that.
Very quickly on the question of permanent capital, and thanks, Josephine. The way I would like to explain that is to maybe contrast it with the traditional private equity model. The traditional private equity model basically says you raise money from investors, LPs, and there's a period of time which you almost have to invest that capital, and then there's a period of time where you actually have to harvest that capital and return it to the investors. Under the permanent capital model, you raise capital. You generally will get pressures from investors to deploy that capital, whether we like it or not. But there's no stipulation on how quickly you need to invest that capital. So you have the flexibility to, as I mentioned earlier, to be opportunistic. And then in terms of exits, you actually don't have to exit. And I think the permanent capital model is well suited for industries that are regulated, because regulators like to see stability or long-term stability in ownership. Banks would fit that description. Certain segments of the infrastructure sector, especially the socially sensitive ones, are more suited for that. But because you don't have to exit, you can actually, again, be extremely opportunistic in determining whether you want to exit, when you want to exit, and how you exit. So it creates all sorts of flexibility that I think enables you to be nimble in creating the alpha that we would like to create in Africa.
I'll take the question on education. So that's an easy one for us. We actually have invested in a private education company that has schools in South Africa and Kenya, and looking to potentially expand geographies within the next 2 to 3 years. It's K through 12, and I think investing in education is. I think everyone sees, similar to other industries, there's a huge potential. I think especially in Africa. Knows the sort of demographic trends and this kind of thing, and so, but it is challenging. I think there's a lot of folks looking at different segments. You've got sort of the bridge academy model, which is the very affordable, low cost model, but you need rapid scale. I think you've seen the entrance of some of the more of the higher price models like gyms coming in. And I think our focus right now is sort of in the middle, and I think there's huge potential. We've had a lot of success in terms of enrollment and growth in Kenya. In South Africa, there's more of a competitive model, and so I think it takes time for your product to really distinguish itself in that middle market. But in places like Kenya, where there's a huge appetite for quality, affordable education, we've seen a tremendous amount of growth there. So it's a segment that we're really interested in and have invested in. I'll just touch quickly on the permanent capital structure as well, because that's also the world we live in. I think all the merits that you've highlighted, Jim, are great. I think one of the challenges, though, of permanent capital is it's generally in a listed environment. And the challenge with being in a listed environment is you can face significant short-term pressures, right? And I think especially in, for example, in a portfolio like Atlas Mara, where you're in 7 different countries, different regulators, currencies moving around, volatility can cause shareholders, especially shareholders that maybe aren't as familiar with markets, to react. They also can put pressure on you to put capital out.
They become non-permanent.
Exactly. And so I think permanent capital can offer a solution to a lot of the challenges you've raised. I think one of the elements, though, that I would look for, this is one of the reasons that we were excited about the platform that we had, was having stability in who actually controls your entity. And I think having a large or significant shareholder in your permanent capital vehicle that can help you weather the volatility, not put pressure on you to make short-term decisions, is really critical in realizing the benefits. I mean, I don't know, Chip, if you agree, having a large strategic shareholder in listed environment is positive. But
Maybe you also want to shed light on, if you have a permanent capital vehicle, obviously investors want to be able to also determine when they get out. You may have a 20-year horizon, but for one reason or another, an investor might say, okay, 5 years, I'm happy with where the investment is, I want to get out. That's why we originally conceived the listed idea. But again, when you're in the building phase, it's, as Trent said, it's extremely difficult to maintain investor permanence, because when the short-term results are not great, they tend to think the thesis is not there. And just marrying that focus between short-term achievements and keeping people on the long-term goal or the long-term prize is something in a listed environment as a permanent capital vehicle is extremely challenging.
Now we have just a few minutes. Can we
It's a
take?
question about private debt. I don't think that's interesting. Yeah, I think somebody talked about private debt. Yes, it's true that there's a rise for private debt, but again, the problem with that is the kind of structure. What kind of structure is only suitable for some kind of sectors, some kind of industries, and is debt. How sustainable, what's the debt sustainability level of the business that you want to take that private debt into? What are the interest rates? What are the kind of receivables? What businesses do they generate? Do they generate dollars? Do they generate naira, local currency? So those usually are the challenges that you have before you consider private debt rather than private equity. We have time for like 2 more questions.
Perfect.
I don't think it's we gender balanced as well.
Hi, my name is Melanie. I'm half Nigerian, half Ghanaian, and we've talked about a number of places that people have come from. And I work at Goldman Sachs in a private investment function where I help family offices and ultra high net worth individuals invest in both public and private markets internationally. So it was based on something you talked about in educating investors. How do you go about educating investors on Africa risk? Who do you think the marginal investor is in Africa in the private space? And do you do any work to attract investors from areas other than the UK and the US and Europe that would be more familiar with Africa-like risks?
So because we are running down on time, can I ask you to choose your favorite question?
You guys can pick my favorite thing, however you want.
Just one last question, guys.
Hi, Wally, Nigeria.
Do Nigerians still have company? Are you a student? Are you?
No, I'm working on a startup. that's kind of building sustainable communities. I'm looking at how people can live, work, and play within 500 meter radii.
What's the name of it?
Ahujo. It's
How you
free
spell
money, pre-revenue. So my question is this. We talk a lot about private equity and money coming into Africa and into companies and businesses in Africa. But purchasing power is still extremely low in Africa. And if we talk about increasing manufacturing competencies, at the end of the day, if there are no people to buy what we manufacture, what's going to happen is going to circle back to raw materials being shipped out. So how do investors like yourself, working with the companies you invest in, push that narrative in terms of you need to pay staff for, sustainable wages, so that what happened in Malawi, for instance, will happen again in other African countries, leading to losses in your investments?
Are you Nigerian?
No, okay.
Hi, my name is Amal Apin. I'm a junior banker at Goldman Sachs. So if you look at private equity from 2013 across Africa, it's been on heady high. It's like the deal numbers, the deal flow, the exit values have been really low. But there's still a lot of companies that are going into the African market and expecting their synergies to monetize. So I'm just trying to, for example, Blackstone has now fully retreated and it's going back to Africa to create a standalone company. So my question is, where does this optimism come from? Like, I would just love to hear your perspective. Thank you.
So who wants to pick one of the three first questions?
Okay, let me just take the first question. I think that has to do with how do you get Africans to invest. Did I get that right?
Yeah, it was about international investors.
So educating them on the
How do you educate them?
Yeah.
Okay, the first thing I would like to do in reacting to that is investors generally, let's be honest, do they need that much level of education to make an investment? When people want to invest, they want to invest, one, in areas that are safe. Two, they want where the returns are. Third, they also want where they get the money back. So I think that's very basic education that most people have, except you want to get into very into other territories that are a little bit more complicated than that. I think in Africa today, our institutions are weak, and we ourselves have to do a lot more to make sure that we strengthen those institutions, because it will provide that much needed education that investors in Europe and in America also want. So we need to strengthen our institutions. Two, we need to also, I told this story sometime and I said, look, why do you think that Africa is the only continent that gets aid from the developed markets? No, Africa also creates aid for them, because each time our politicians take our monies and take them abroad, that's aid for the So that same money is recycled back and invested in Africa. So when you invest it back in Africa, it's aid. But when we steal money and give them back to them, it's not aid. So I disagree with that. So but seriously, the issue is we believe that most of the learning, most of the education that investors require in Europe and in America will be those that are created from within. That's my simple answer to that question.
Maybe I'm being pressed to follow up on a risk profile question.
Yes, follow up.
Okay.
So quick answers for the rest, please. I know we're running down on time.
I think I'll take on the optimism question. I think it's easy to look at from a macro perspective and see the opportunity of education. The question, I think it's easy to see there's a huge demand for education. I think on the infrastructure side, it's very easy to see there's huge need for infrastructure investment. That's why the Blackstone originally got into the Black Rhino investment. So I think it's very easy to see the need for investment. And so I think that's why people are optimistic. I think one of the, I think, main focal points that we discussed is some of the challenges of actually translating the reality of those opportunities to the reality of actually successfully investing and realizing the potential of those opportunities. And so I think we're all here because we see those opportunities, but I think it's the challenges of coming up with unique creative solutions on how to address them is what's critical.
What is important is really growth. We are in Africa, so it's countries of growth. So despite this volatility, if you see the long-term growth on those markets, it's above 7 to 10% market, and you don't find it elsewhere. So whereas PE funds buy companies in Europe to restructure it or to turn around, here in Africa there is still a question of growth, and it's more easy to manage that rather than turn around the company. So we are still
Theoretically.
exactly. And this level of growth, we just need to be sure that it's offset all the risk that we have talked about. But this is if we still have those inflow, we still have some really good PE firms that are focused on Africa with a very large team of professionals, because there is a huge potential.
Thank you all so much.
Thank you
Please
very
give them a
much.
hand.
What was your question again? What was the question again?
Purchasing power, if there's no purchasing power, how do you work with your investors to, push the issue and talk about compensation for staff so as not to have another Malawi happening over and over with the investment?
Well, I think the issue of purchasing power, the things that drive the demand is what we need to focus on. And I think over and over we've talked about some of the issues that stifle that. First, once our institutions are developed and they are not weak, we think that we'll make better decisions. We think that and consumption will be higher if our economies are doing well. And let me just give you this. How much do you think comes into Africa as remittances on an annual basis?
22 billion.
It's far higher than 22 billion. It's over 40 billion. If, and I keep saying this, if Africa with 54 countries, you take all the Africans in the diaspora as the 55th country in Africa, it will have a GDP of in excess of 650 billion. Now, with a GDP over 650 billion, that's comparable to what you have in Nigeria and in South Africa, independently. That is a massive GDP that can turn the continent on its own. And those are the issues that can create wealth and that will lead to higher consumption. Once the consumption is high, then we find that the economies will do better, investments will come. Why do you think investments are going to countries like Rwanda? They have their laws right, they have infrastructure right, people are willing to go there. The uncertainties have gone down like you have in other. So these are some of the variables that we need to deal with independently as African countries.
I know you guys don't want this to end, but this has to come out. Yeah. Thank you so much.